My guest today is Jonathan McGuire. Jonathan is on the real estate team with Aldrich Advisors. Jonathan is a returning guest to CREPN Radio. Jonathan, welcome back.
Hey, thanks for having me back, Darren. I appreciate it.
Well, I'm looking forward to talking with you today. We're going to get into a little bit about the new tax laws and how they're going to affect real estate investors and individuals. And but before we do, if you wouldn't mind just taking a minute and sharing with the listeners a little bit about your background and your role there at Aldrich Advisors.
Yeah, so I am a CPA at Aldrich Advisors, where I work particularly with our real estate clients. I'm on the tax side, so I'm working primarily with dealing with your annual tax filings, tax planning, helping develop strategies and entity selection on how to structure everything correctly so that you're maximizing your tax efficiency while protecting yourself on the legal end as well with whatever your attorneys want to do.
Got it.
And so, yeah.
Well, and that's a big, important issue with all this going on, and certainly more so now with the new tax laws. I'm sure you're a little busy.
Yes.
Yeah.
It's been surprisingly, I'm actually, from what originally was proposed in the House in the first bill that they passed, things have been simplified a lot more than what it was going to be change-wise for us. So in a way, it's made it a little bit easier to absorb, but there still are some pretty substantial changes that I don't think, we have fully, even the best of us haven't fully been able to absorb and walk through all the way, because it's still so new, and we have a year until we actually have to do the exercise of preparing returns with these new laws.
Right. So just to be clear, the new laws don't affect the past year, 2017. They're effective going forward 2018, correct?
About 95% of it is 2018 and forward. There's
Okay.
a small percentage that clawbacks into 2017, of which mostly are to your benefit. But we can get into those details later.
Okay. Well, why don't we start with, can you summarize kind of like a big picture of what the new tax, and is it tax law, tax code? What is it?
The terms are interchangeable.
Okay. All right.
Yeah.
So let's talk about the new tax law more like from a 30,000-foot view in general here.
So regardless of the political side, the intent of this was to simplify the tax code and create a tax break for the American people and for businesses. And what ended up happening is the things that are probably what most people will pay attention to is the individual tax rates ended up getting reduced. So current or under old law, the highest rate was 39.6%. Under the new law, it's going to be lowered to 37%. So, and then all the other income tax brackets essentially are getting somewhere between a 2 to 3% rate cut.
All right.
So there's at the 30,000-foot level, just looking at that, you have a tax break there from the individual side.
Got it. Did they keep the same number of tax? I guess I don't know what you call them with the tax rates. I mean, I know before was there seven different tax rates before?
Yeah, there's still 7 brackets.
Okay.
They've just notched down the rates on those brackets from what they originally were.
All right, and still the same income per bracket, or did they change the brackets at all?
The brackets are changed a little bit, not much, but I definitely on the upper end you'll see a little bit more of a tax break there from where the brackets are, but materially, it's not going to change much for those individuals. So,
Okay. Got it. All right. Anything more on or is there more we can kind of summarize on just the 30,000 foot view before we get
yeah,
into the details?
yeah. So that's the individual side.
Mm-hmm.
On the corporate side, which is where I think the real tax reform happened, is we've essentially gone to a de facto 20% flat tax for corporations. Now these are just C corporations, not S corporations that pass income through to the individual, but C corporations are going to have a 20% flat rate going forward.
Got it. And before that was how
It was
high?
up to 35%.
Okay, that's pretty significant tax break there. So
Yeah, it's that there was definitely a economic purpose behind that to, you know, with the big multinational corporations that hypothetically are paying tax, giving them the tax break. The idea behind it is it's going to trickle down into higher wages to individuals because there's less tax burden. So we'll see what happens, but
yeah. No, I understand. They gotta have the theory here before we can test reality.
Yes.
So essentially, the C corps were the ones that benefit from that. The S corps, LLCs, and all that were unchanged. Is that right?
Yeah, they're still going to be subject to whatever your individual rate is because all that income's going to pass through. But later on, we will see that there's a new pass-through or business income deduction for individuals. That way, you don't have everybody trying to flip to becoming a C corporation to be taxed at that 20% rate.
Right.
So,
Right. Okay. Is there anything else? I mean, the individual there and the corporate rates; those are the big kind of a 30,000 foot view. Is that right?
yeah, and I've to go just a little bit deeper before we start getting more into real estate specific stuff. The alternative minimum tax
All right.
for individuals, it still applies. It's just the threshold to where it applies has gone up. I don't have those numbers in front of me at the moment to know where it is, but I believe it's about a $20,000 to $30,000 increase in income before it starts applying from where it currently is.
All right. And what you mean there is if you make less than that or up to that amount, you can just take the alternative minimum as opposed to.
The alternative minimum is supposed to be if your regular income tax is below the alternative minimum tax.
Okay.
If your regular tax is below, you have to pay the alternative minimum tax.
Oh, gotcha. Gotcha.
But so that's the what people were expecting was it was going to get repealed entirely. It didn't happen, but that's okay. But on the corporate side, it is gone because they have that 20% flat rate.
Gotcha. No corporate alternative minimum.
Mm-hmm. And then going forward into like itemized deductions, which will kind of lead more into real estate. High level, your charitable contributions. Previously, that was limited to 50% of your adjusted gross income. Now that's getting bumped up to 60%. Additionally, they're suspending the limitations on itemized deductions. So previously, if you made a certain amount of money, there would be a phase out of some of your itemized deductions. That is suspended until 2026.
All right. So with that, if in the past and up till now, if you had expenses that exceeded a certain amount, you basically were required to just carry those forward. I mean, because you could only take a certain amount. Is that what I'm understanding? Or
on the individual side, they would be disallowed.
just disallowed. Okay.
Yeah, because the idea was if you made too much money, you're not going to get the full benefit of your itemized deductions.
Gotcha. And now that that's been eliminated, you're allowed to take the full expense, correct?
Yes. Yes.
All right. All right. How about we talk about the real estate specific stuff?
Yes. So, in line with, Schedule A still for your itemized deductions, there's a couple things in there that I want to highlight. The mortgage interest deduction, it's still there. They didn't get rid of it. What they did, though, is they capped the amount of interest that could be deducted from what it previously was. So, let's say under the old law, if you had a loan that originated at $1 million or more for your principal residence, any on a pro rata basis. So let's say you had a $1.5 million loan, only up to $1 million of that loan could be used in calculating your deductible interest. So 1 million divided by 1.5 million, that's a 2/3. So let's say you had $50,000 of interest, or 45,000, make the math easier. That ends up only allowing a $30,000 deduction for your mortgage interest.
Okay, and that's current, or that's the new?
That's the current.
Okay.
The new one is they're reducing this down to $750,000. So instead of the $1 million cap, they're reducing it to $750,000.
Okay, so if you have a $750,000 mortgage, the interest associated with that is you can expense that fully?
Yeah, up to that you can expense it fully. If your mortgage is at its original basis is over $750,000, a percentage of that will be non-deductible.
All right. So I'm trying to think there. If you, it's kind of a roughly the same, is it not, based on the fact that I guess before you were allowed up to the percentage of the mortgage to the value, whereas now you're allowed the full up to the mortgage up to 750. Is that right?
Yes. So
okay.
So if it's really clawing back against people buying $1 million homes that they're financing all of it.
Right.
Yeah, they might have the cash to pay for that mortgage, but they didn't necessarily have the down payment to gross up to cover everything. So it's basically hey, you can afford a jumbo loan, we're going to claw back your deduction for that because you're in a higher tax bracket. We don't need to give you more of a break.
Gotcha. Does that apply to second homes as well? Do you know?
The second, I don't remember off the top of my head.
Okay.
I don't remember what they changed there. But generally, your second home, I believe under the old, you can have up to 2 residences on that. Plus the if you had a HELOC out there, that would, I think, I haven't read anything to where they've gotten rid of the HELOC deductibility. So.
Okay. All right. So is that the basics on the interest changes? Is there anything on the investor side of things? I mean, that's kind of more on the individual.
Yeah, on the investor side, there definitely is a change, and that kind of what they're doing is they're putting an interest out there, or a limitation on deductibility of the interest going forward, and there's kind of a convoluted calculation here, which I had to write down to make sure I can speak about it fully. But what for deductibility of interest on the business end, it's going to be subject to your business interest income plus 30% of your AGI plus any floor plan financing interest. So let me break that down for you. So business interest income, if you're in the business of or let's just say you have interest income in your business, that gets included in this calculation. 30% of AGI, so 30% of the business income of your entity. So let's say you have before taking the interest deduction, you have $10,000 of income. Only 30% of that would be allowable in this calculation of your business interest deduction.
Oh, really? So if you have $10,000 net operating income, you're only allowed to write off $3,000 then of that interest.
Yes, and
that's huge.
So, yeah,
that's huge.
Yeah, there are some exceptions here, but there's so you add that business interest income component, that AGI limit, and then the floor plan. That the floor plan financing interest is more applicable to auto dealers, right, where they have to finance their inventory. So from a real estate side, that's not going to apply for us, but that's just a component of the calculation. So let's say you've got $1,000 of interest income, and then you had a $10,000 operating income. Based upon this, your deductible interest is limited to $4,000.
Wow, and that's significant, is not, compared to what the law's been up to this point?
Yeah, prior to this, all interest was fully deductible, no matter what.
All right. Does this matter if you are an individual, an LLC, a corporation? Does it vary? I mean, it's just flat out real estate investment. Here's the tax.
It actually does matter. So one thing that I do want to point out, though, two things before I get into the exception: any interest that you have that is disallowed is carried forward for, I believe it's up to 5 years. So if, let's say, you have a bad operating year, but you had a bunch of business interest expense, you're able to carry that forward and deduct it in the upcoming years. Still subject to that limitation.
So you could use that then if you went to sell and you had a gain as an expense then?
Yes, because I believe that would be part of what would be deemed the adjusted gross income of the entity. Because this business interest limitation applies at the entity level rather than the individual level. So even though you might have, gobs of income on your 1040, let's
right,
say you have this partnership that you're in where it's, loaded heavily in a debt finance property, where you're going to have a lot of interest being paid, and so you're kind of using that as a, kind of a tax loophole to reduce your overall tax burden on the other end.
Right.
You're not going to necessarily be able to use that like you were previously, because the business interest was fully deductible. Now there's that limitation. So when it comes through to you, before you would just get that full credit of your share of the interest expense. Now it's applied at that partnership level, even though maybe at your individual side you have tons of business income that you could offset that interest. So they put that in there specifically to make it easier to calculate the limitation, because otherwise you're going to have all this income coming from everywhere. It's going to be impossible to do tax planning.
Got it. So just to make sure I understand, so the individual, you've got the cap on your individual mortgage, but if you're investing as an individual, this cap of the 30% applies. So if you have a property and Jonathan owns a property, he's got a mortgage on it, he's renting it out. You take your rent less your expenses, you get your net operating income, then you've got this mortgage, and the interest paid against the mortgage. now is you can only write off 30% of that in relation to the net operating income?
Yeah, that's what they're saying.
Okay.
And so, and that's the general rule. But in tax law, there is always an exception to the general rule. And the exception, I believe, for most real estate investors is going to be fairly good. It's going to hurt people that are investing in, the skyscrapers, so to speak, the over $25 million entities.
Gotcha. So are you going to share the exception?
Yes.
Okay, good.
So I've got this written down because I want to make sure I read it correctly, and is that there is no interest exemption for taxpayers with average annual gross receipts that do not exceed 25 million. So
everything you told us now, we can come back down, sit in our chair, and listen, because it's the 30% doesn't apply.
Yes.
Unless you're making more than 25 million.
Yes, and that's gross. So if you have rents of more than 25 million in that particular entity, then your interest is going to be reduced. If you're below that 25 million, it's 100% deductible. We're jumping up and down. Happiest plans.
Nothing changed if you're under the $25 million in rents.
Yes.
Right? Okay.
Yes.
Okay.
But the idea is it's actually going to hurt, big business more with the interest deduction, because where they're doing financing of, XYZ product or piece of equipment or whatever, and they're bringing in millions upon millions of dollars in ordinary business income. Think of Walmart. They're going to get hit by this interest cap.
Right, but they've reduced their income tax down to 20% as opposed to the
Yes.
higher. So they're the yin and the yang of that. What prevents a sophisticated taxpayer from hiring Jonathan McGuire to create entities that one entity owns the equipment, the other one owns the goods and all that, just to try and kind of silo their different their exposure.
And that's a great tax planning tool right there.
I was going to say, so I mean, it's basically, it's written there, but I can't imagine that anybody that's making more than $25 million is going to just go, gosh darn it, we got to pay the taxes.
Yeah. The vast majority of taxpayers are not going to exceed that $25 million
right.
Limitation level. So, but if there are the ones that are over that 25 million, that from the way I'm reading this and our initial understanding is it's that interest limitation is determined on an entity by entity basis. So instead of having everything wrapped up in one entity, maybe you make it off into 2 or 3 entities, and that interest is going to come through, be deductible for you.
You go individual stores or departments or whatever kind of thing. So I gotcha.
Yeah.
All right. Well, good. Now that you got us all excited about losing, now we're back to square one.
Yes. Yeah. And then another caveat too with that is there's also another exception to the rule, which is specific to real property trader businesses. They can opt out of the business interest income limitation if they choose to go on to a slower rate of depreciation.
So wait a minute. So, what was the category? You said trader businesses?
Yeah, real property trader businesses. So rentals, or even I'll think of XYZ partnership that owns $100 million skyscraper in San Francisco. They're going to be able to opt out of this business interest expense limitation if they decide to go ahead and use what's called the alternative depreciation system. All that does is it just slows down the depreciation of the building by a couple of years.
Okay.
And so,
And let's talk about this real quick because this is a good chance to ask the question. So one of the things I did read was a little bit about depreciation schedules. Up to this point, I believe residential was, 27 and a half years, and commercial was 39 years. And was that not changed?
they ended up not changing that.
Oh, really?
At one point they were proposing reducing. No, I think they were going to actually potentially increase it at one point to 30 years for residential and then 40 years for commercial. But then on the other end, some people were at one point they were saying, "Oh no, it's going to be 20 years for residential and then 35 years for commercial." So there was a lot of negotiating, and they decided to just stick with the current lives.
So the final print of the tax law did not change the depreciation schedules, correct?
Correct. Yeah.
Okay, because I'd read something else that I thought it said was 25 years or 20 or 25 years is what it all been switched to. But you're saying they flat out the final is forget it. We're the same schedule, right?
Yeah, that was one thing that got put on the chopping block after the House and the Senate went to conference to make the bill work together.
All right. So that then. So what about expenses? I know in the past, around depreciation, there was, if you just go straight line, you take the the structure and you just map it out based on the depreciation schedule. The segregation studies are a unique tool to kind of break the building into components and then expense various items at various rates based on a more aggressive or a shorter life expectancy of various components. What did they change anything with the expenses? I was under the impression that there have been some changes with the ability to expense.
Yes, they've become very real estate friendly. I think you can thank the person that's in the White House for part of this, but since he is a real estate guy by trade. But so with staying in the vein of depreciation, there's two major changes. One is temporary, one is permanent. So we'll start with the temporary one, and this is a really big deal, and that's you get to take 100% bonus depreciation on any property placed in service between now and 2022 that is of a 20-year life or less. So what that means is essentially any property or anything that you buy that is not a building, you can expense immediately.
Okay, so not real estate per se, but equipment.
Equipment, but within the cost segregation studies, you're going to be able to include.
Okay, so your heating and or air conditioning or but does that not normally attach to the building and become part of the building, or how's that? What's the line?
It's like air conditioning or like electrical or plumbing.
Roof.
Even though it's not part of the building shell, but it is part of a building system. So it's still considered, for tax purposes, it's still considered part of the building.
Okay.
For the depreciation life. But if you have fixtures, the cabinetry, carpeting, or wallpaper, curtains, whatever, all those miscellaneous items that get thrown into the finished product of the building, you're going to be able to expense those at 100%.
Okay, so that basically wipes out the need for the cost segregation study, does it not? From a standpoint
No.
of no?
No, you still need to have the cost segregation study to be able to break out
Oh,
those
okay.
those shorter lived properties from the overall building. Because otherwise, if you don't have that study done, you run the risk of the IRS saying, "Oh no, it's all part of the building, and we disagree
Gotcha.
with your allocation of what you're doing." So it's if anything, it increases the value of what the cost segregation study is providing because of
Gotcha.
the 100% bonus depreciation.
All right. That sounds good. What about 1031 exchanges? Was there any change to that?
Um, there is change to it. However, it's not going to affect real property. So the 1031 exchange for real property. So this could be land for building, building for land, land for land, building for building. Anything that's dealing with real property is deemed to be like kind,
Okay.
and that stays unchanged. At one point, they were considering getting rid of it, but we can thank the realtor, or not realtors, the um, there's a real estate tax lobbying for I forget their name off the top of my head. I've talked with them before, but they ended up being able to salvage that one for us. So
Good. Good.
what?
Well, I know that would change a lot of people's disposition with respects to real estate. If you're, making it more difficult and you got to pay the tax right off, that would change that. So that's good.
Yeah. Where it would hurt is if you're playing on both sides, to where you're not only in real estate but you're on the construction side. A lot of those guys, they have their really big pieces of equipment.
Right.
They're not going to be able to do a like kind exchange on that equipment going forward, because the ability to do so has been wiped out.
But do they not get the chance to expense the item 100%?
They do, but come 2027, that 100% bonus depreciation is going to be fully phased out,
Okay.
unless Congress decides to step in and extend or make permanent bonus depreciation.
Gotcha. Well, I can imagine that there's a few big equipment, groups out there that might have a say about, how to lobby for that to protect that. So,
Yeah,
but
I think the construction industry,
yeah,
come 2024, 25, they're going to get together and try to get
salvage
something
that.
done.
Yeah, no, that makes sense. Um, what about real estate taxes?
Yeah,
Is
real estate taxes. So on the individual side, going back into the itemized deductions,
mm-hmm.
um, you're only going to be able to deduct up to $10,000 of state and local taxes, period. So what that includes: your real estate tax, your state income tax, any state sales tax, or personal property tax that you pay on an individual level.
Okay, so back up here 1 second. So you're Jonathan. You're in Oregon.
Mhm,
You file your federal taxes,
mhm.
and I believe currently do they not allow you to take your state taxes and deduct that from your federal taxes?
Uh, Currently, your state taxes get included as part of your itemized deductions.
Okay.
Your real estate taxes get included as itemized deductions. And then let's say if you're in Washington, you'll have sales tax up there that you could hypothetically deduct. And
Right.
then, there's a handful of states that have a personal property tax component on their car tabs. I used to live in Washington for a few years, and that was something that they had up there when you did your annual car tab registration. They had basically the bus system had a
Right.
tax built in to the car tabs, and so that was deductible on your Schedule A. And
Okay.
so
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 So go ahead, go forward now. So
Yeah. So let's say we have me. I'm in Oregon, where I have a home where I pay, $5,000 worth of real estate tax, and then my state income tax liability is $10,000. So
okay,
I'd have $15,000 that I would be able to deduct on my Schedule A under, 2017 tax law.
okay,
Come 2018, that is limited to $10,000. So I lose a $5,000 deduction.
okay. All right. So are you going to share the exception on that, or is there an exception? Is there a give back on that, or?
Sadly, there's no exception on that one. However, this is temporary until 2026. In 2026, basically on the individual side, we revert back to the way things are right now.
Gotcha.
The,
And does that hold true? Is there any kind of a similar issue? I guess, well, corporate, unless you're a C Corp, if you're an S Corp or an LLC or a partnership or an individual entity, all that rolls through to your individual tax return, right?
yes. Yes.
And then from there, I'm assuming that does all that tax follow? I mean, or is that just your individual, your income and your property tax for your residence?
Yeah, it's just going to be what you deduct on your Schedule A for federal purposes. So if you have your partnership or S corp where you're paying real estate taxes inside of it, and then let's say you're in New York and you pay a certain amount of income tax based upon the partnership, plus New York City has its own tax on it. You're going to be able to deduct that stuff inside of the partnership.
Okay.
Because it's sourced at the partnership level. Because I believe, because some states, they pass all that income through and they tax it at the individual level. Others will tax it at the entity level. And I believe New York is one that taxes it at the entity level. And so that tax then, I believe, will stay deductible. Since I'm in Oregon, you're in Oregon. Oregon doesn't do that. They pass it all out. Yes, Oregon has like $150,
right,
filing
just a flat, yeah.
But and that's deductible. But all that income is being passed through to you at your state level, and so you're going to have to pay tax or you're not going to be able to deduct that tax because you're paying it at your individual level.
Got it.
Yeah.
Got it.
That's kind of where the issue is. So
so it sounded like up until that right there, it sounded like everything was in pretty good shape.
Yeah.
As far as the wins, it sounds like the big issue is on the individual or at the individual level about on your Schedule A about the cap on the tax you're able to write off. And I guess again also if you've got a mortgage that's greater than $750,000, you're going to be limited on what you can write off.
Yeah, and at that point, that I don't think that one is as big as a deal. It's because if you're able to afford that $1 million mortgage, one thing I do believe is existing mortgages might be grandfathered in to be excluded from the 750. I remember reading something about that, but I don't know if it made it into the final. I've got most of the changes in my down, but there's some of them that I'm like, wait, what happened? I don't remember the fine details yet. So,
gotcha. Is there any of this that's still subject to iterations, or is this the final got signed? That's what it is.
So what is final is the general rules.
All right.
There are still quite a few rules that are going to come out through regulations, because we're going to need guidance on how to treat certain aspects of these changes, because they put in broad terminology, and and they loosely define things. And so we're like, okay, this is great, but we need help on, can you further define this or further define how you're going to operate this? How is the calculation going to happen? What is the IRS expecting it to look like?
Right.
And so that's where the Treasury Department comes in, and they help along with the IRS to more or less make it easier for us as CPAs, as tax practitioners, to be able to know what to do and structure things for you as the real estate, investor, professional, to maximize your tax benefit and make sure you're in full compliance.
Gotcha. Well, we talked about the entities, the interest rates, expenses, exchanges, and then also taxes. Mm-hmm. Is there anything we've not talked about that we should cover for the real estate tax or the law and how it affects real estate investors?
Yeah, I've got three major things that I know we haven't covered yet that I want to.
All right.
One is actually going back into the depreciation area. Most people have heard about what's called the 179 deduction. This is another form of bonus depreciation, except this is the one that's permanent. Previously, what I was talking about was, the 100% expensing bonus depreciation. That one's temporary and is being phased out over time. 179 is a permanent item. Now, historically, when we think real estate, Section 179 historically hasn't applied to real estate. But now they've expanded what gets covered in this, which is a big deal. Excuse me. The first thing is they're now expanding the definition of what is Section 179 property to include what is called qualified improvement property. So what that is certain improvements made to non-residential, or I believe it's residential and non-residential real property. What it is if you have improvements, so let's say you put on a new roof, you change out the HVAC, you do something with an alarm or security system, that is now included inside of what is called qualified improvement property. So if you buy a new roof, historically, you depreciate it over 27 and a half or 39 years.
Right.
Now you can take 179 and expense it all in the year that you make the improvement.
Wow.
So that is a really big deal that I think is going to spur a lot of renovation and upkeep type activity here in the next couple years, because in my opinion, if you remember back, the first time that we talked about the repair regulations.
Right.
In the repair regulations, they tried to define what's a capital improvement, what's a repair, and then they also added in a partial disposition election. So staying in the vein of roofing, if you would just replace the shingles on the roof, that was deemed to be a repair, upkeep in the ordinary course of business. If you took it down to the studs, to where you're putting on new plywood, new everything on the roof, a brand new roof, you'd have to capitalize that.
Right.
And depreciate it over 27 and a half or 39 years. With the partial disposition election, you would be able to write off your old roof. So that was the first big deal change, was okay. You would potentially be writing off 5 roofs over a 39-year period. Now you can just write off 1. Well, with what they're doing in this new expanded 179 deduction, you're able to write off the new roof now and fully expense it, but you're also still going to be able to dispose of the old roof via the partial disposition election.
Oh, really? So you get both, and
Yes.
immediately. So let's slow down just 1 second, make sure I'm following you. So I buy a building. I've had it in service for 5 years. It had a a 27.5 year depreciation schedule. So I've still got the 22.5 years of unused, and I got to replace my roof. So I could take that 22.5 years, expense that, plus the expense for the new roof.
Yes.
Wow. Woohoo.
Yeah.
That's
Yeah.
a win.
Yeah. There are some limitations on when you're able to use 179, but in the case of a roof, you're able to expense up to $1 million of property using 179, and there's a phase out threshold once you have $2.5 million of total purchases. So if, let's say, you buy $3 million worth of depreciable assets in the given year, a portion of that $1 million that you could immediately expense gets phased out.
Gotcha. But you're not talking about the total asset value. You're talking about the qualified improvements limitation. So if I buy a $5 million building and I put a $1 million roof on, I mean, just for example, the $1 million is able to be expensed, correct?
Yeah, that $1 million would be if you separated them by year, because what they're looking at is the total amount of purchases in the current year.
Okay, including the real estate.
I believe so. I don't have that in front of me at the moment, because historically real estate and 179, they just don't go together. But
Okay.
now that they've expanded it, I'm still trying to wrap my head around what they're doing with this one. But on the higher level, we're going to be able to expense that $1 million. Say, like if you put on a $1 million roof and you had no other major expenditures.
Right. Plus the unused portion of the old roof. Right.
Mm-hmm.
That's huge.
Yes. It's
Okay. All right. You said you had 3 of these things. What's number 2?
number 2, which kind of goes back to the individual side. And I think I briefly touched on this at the beginning, but they're going to have what's called there's a new qualified business income deduction. So what does that mean? Well, let's say you're an individual and you either have a sole proprietorship, or in our case with real estate, you're probably going to have some partnership interests, and you're having income flowing through to you from the partnership.
Okay.
What they have proposed is, because with the corporate rate being reduced to 20%,
Right.
and individuals being at the high rate of 37%,
Right.
they put this deduction in here to help mitigate the tax rate arbitrage that happens there, to prevent people from flipping to C corps and taking advantage of that lower tax rate.
Okay.
And that way that way you don't have to go through the legal loopholes of creating all these C corporations, and the attorneys would love it, but
Sure.
you and I will be like, oh, this is a headache. I don't want to.
Yeah. So much for simplifying the tax code.
Yeah.
So if I have an LLC and I've got property that's owned in the LLC, the income coming through that does not get taxed at my individual rate. Does it get taxed at a lower rate?
Well, in effect, it's going to have a lower rate, but the function of it is, what they're doing is a 20% deduction on your qualified business income. So this is income from a partnership, S corporation, or sole proprietorship. That is just and we're just looking at the trade or business income. So it excludes dividends, interest, capital gains, anything that's not going to be, rents will qualify because that you're in the trader business of renting a building.
Okay.
20% of that taxable income that's coming off of or flowing through to you is going to be deducted.
So, in just simple terms here, if you had just keep it really simple. If you had a building and you were getting $100,000 in rents and your expenses were roughly 50%, get you down to the $50,000 of income. Mm-hmm. That income then would be taxed, or 20% of that income would not move over to your Schedule A. Is that what I'm understanding? Or not your Schedule A, but your income?
Yeah. So all $50,000 mm-hmm. of income will flow onto your tax return.
Okay.
But then if you can envision a 1040, right, the front page of the 1040 in your mind, on the bottom half there's the adjustments to your gross income.
Okay.
This is going to be the last deduction on that adjustment to gross income.
And that's just for the income that came from the entity.
Yeah, just from the entity or from, say, your Schedule C business.
Okay.
Because sole proprietorships are covered under this. There are some thresholds, though, to where this could get phased out. If you're in like a services business, so financial professionals, consultants, accountants, anybody where you're being compensated for your services.
Right.
Once you hit $315,000 of taxable income, if you're married filing jointly, there begins to be a phase out of the allowance of this 20% deduction.
Gotcha. All right.
And that's one of the phase outs. There's another one that exists. If married filing jointly, you have $315,000 of taxable income coming from qualified business income or just income in general. You're going to be subject to the higher of two limitations. So hold on here with me for a second. It's a little, there's some math involved here. You have 50% of your W-2 wages or 25% of W-2 wages plus 2.5% of the cost basis of the assets inside the trader business. So I've got an example here to kind of help give you an idea.
Right.
So let's say you have an investment partnership. Let's say it's owned 50-50 between husband and wife.
Okay.
They buy this building for $1 million and they placed it in service in 2015. Okay. The business has no employees in 2018, and let's say their adjusted gross income before taking into account this 20% deduction is it's completely phased out. So that means they have adjusted gross income of over $315,000.
Okay.
So then we have to do a limitation. So we look at the greater of A, 50% of W-2 wages from the business, or B, the sum of 25% of W-2 wages from business plus 2.5% of the cost basis of the building. So since it's a rental, you're not going to have W-2 wages coming out of it.
Right.
So that first one, the greater of 50% of W-2 wages, that's nullified. So then we go to Part B, which is 25% of W-2 wages, still zero, plus 2.5% of the unadjusted basis of the building. So going back to 2015, they purchased the building for $1 million. So 2.5% of that is $25,000. The amount of the limitation that they can deduct for the 20% is up to $25,000 of taxable income from that rental partnership between the husband and wife.
Okay. Got $1 million building. We said 2.5% is 25,000, right?
Yes.
You've got the income. You can back me up here a second. I was listening there. I was tracking, and it's because we were trying to figure out. So the W-2 wages are not in play.
Yeah.
So we basically have the income from the building, and so roughly, I don't know what if you an 8 cap. I mean, that's pretty generous, but if you said we said $1 million building times 0.08 be $80,000 net operating income.
Mm-hmm.
Okay, and so that's the income to them before they do any mortgage. So we're sending to paid cash for it. Mm-hmm. So $80,000. We got the $25,000 calculation in there is the percentage of the asset value of the original acquisition. Mm-hmm. What's our taxable income? So
that 20% deduction would then be limited to $25,000 of income. So in our case, 20% of 25,000 is 5,000. So we'd be able to take a $5,000 deduction from the $80,000.
Okay, I got you. And so then that's what your adjusted gross goes down to the 75.
Yes.
Gotcha.
Yeah. So that it's kind of a convoluted deduction that has multiple aspects of it that you have to jump through.
Yeah. So much for the simplification there. You that's a zinger. But that's important though.
Yeah, but in most cases, if you have past or qualified business income, unless you're making a lot of money, just assume that 20% of that income is going to get excluded at your individual level.
Gotcha.
That's the summarized version. So that's a big win, I think. Okay. It's something that that no matter what industry you're in, you're going to be able to take advantage of that and enjoy a nice little tax break.
All right. Is there a third? You mentioned there were 3 of these things you were...
Yes. The last, which was kind of a campaign issue for Trump, was dealing with the carried interest rule. So what that is let's say you have, hedge fund manager or, some investment management entity that gets, a certain percent of interest in a partnership for their services of managing the corporate or the entity. It's not a corporation, a partnership. What they wanted to do was, because what they were doing is they would get these interest in the partnership at a discount because they don't have control, but then the fair market value of them would grow at over a year or two, and then they'd sell it off because they would have held it for more than a year. They would get a long-term capital gain.
Right.
What they've done is they've extended the holding period for 3 years on a carried interest interest in a.
Okay, so you can't go 366. You got to go. 3 years. Yeah.
Yeah, 366 right. Plus 2 years.
Yeah. Okay.
Yeah, and that's. I don't know how many of your listeners that will affect, but it is something to consider, because I know there are some people out there that they make their money from managing the overall investment, and that they've been kind of living on hey, I'm gonna put everything into a long-term capital gain, so it forces them to actually stay within the confines of the business to make sure it operates, to make it look like they actually entered into it for a true investment purpose
Right.
rather than as a service.
Right. Right. No, I think I've seen that more where somebody's either developing a property and somebody comes along wanting it more than they do, and before it's put to its intended use, or before they've held it for whatever amount of time, they go, well, we can do that, but we need the sale to end or to happen on this date, so that kind of thing. But when you're making 3 years out of the deal, that changes your hold plan a little bit, I suppose.
Yeah, so it in a way it ties up your capital, and it's a little less flexible from going from job to job to job,
Right.
doing whatever it is you're doing with your carried interest. But overall, I think that was probably a good plug to a loophole that existed there. But is it going to be beneficial? I don't know. It could be detrimental because it's going to be less people, trying to enter into some of these bigger investments. But then again, I say the jury's out if that's going to be a negative or a positive.
Well, I guess 3 years time will tell, huh?
Exactly. Yeah, exactly. Well,
Yeah.
there's so much other stuff that's going on that I think is going to spur economic development. Um, and so yeah, you might. This is basically a, hey, we're going to kick the hedge fund managers because that's what everybody was barking up a tree about during the election cycle. And
Yeah.
so I'm like, okay, great, they took care of that issue, but look at everything else that they've done. I think overall this is a very, very pro-business tax bill.
Yeah. No, everything you've laid out here, and especially the 179 deduction sounds fruitful, and the rest of it seems like it's pretty much green light, unless you were planning on turning your properties in just a little over a year. Every year that might be a little bit of a showstopper or change your game there a little bit. But otherwise, it sounds all very manageable. Unless if you're doing 25 million gross in revenue, then you might have to rethink or hire somebody like Jonathan to help you.
Yeah.
Structure. Yeah.
Then I get to have fun.
Yeah,
So,
exactly. So yeah.
I'll admit I like to geek out on some of that entity selection and structuring. So it's that's where it's fun for us because we actually get to do the tax consulting rather than just the compliance, and that's where we feel not only as CPAs but here at Aldrich in particular, we like being able to help the client structure things to be able to achieve their goals and exercise the due care that they deserve, and making sure that they're maximizing their tax savings overall.
No. Well, and that sounds like you're going to have, clearly there's going to be some people in there that are going to need some help, and those are probably bigger operations that have more balls in the air they got to keep in the air. So that's good.
Mm-hmm.
So,
Yes.
All right. Hey, Jonathan, where can listeners go to find you, connect with you, or learn more?
You can go to aldrichadvisors.com. It's ALDRICH advisors.com. You can go there. You can either find me there's a people search function in there, or you can also look under the real estate for the industries that we serve, and you can look me up, Jonathan McGuire, on there, and my contact information will be on there, or you can just just call the main office number and connect with me that way.
Got it. And I'll list all that on the show notes there for our listeners. Okay. Jonathan, thanks again for taking the time to talk. And I'm certain there's going to be more revealed as we go through this first tax year or I guess next year. This will be probably a good opportunity to revisit, make certain did it play out as it was intended, or what surprises came from the tax plan
Yes.
there.
We're fully expecting some hidden surprises that are going to rear their ugly head from some vagueness in language that always seems to creep its way into these tax bills. So,
yeah, no, well, it certainly sounds like there's plenty there to surprise someone. So that's good. So, Jonathan, thanks again. We'll look forward to doing it again soon.
all right, thank you very much.
All right, and for our listeners, if you like the show, share the show with someone you know so they can hear how to benefit from the revised tax plan and grow their real estate portfolio. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.